that anybody can trade in these. It's not just for big banks and big organizations. My guests are here with me this afternoon. David Irungu from the NSE, Johnson Derry from ABC Capital, and Kevin Gige from Genghis Capital. Gentlemen, thank you for joining us. Let me begin with you, Johnson. Why do we say government securities, that's T-bills and T-bonds, are risk-free? Like, is it a 100% guarantee, and how do they compare to others, say if you want to buy shares and stocks? So
the reason why they are considered risk-free, well, they're not really risk-free, but they have I think the lowest risk possible, is because government most of the time will be able to pay. And the reason why they're able to pay is, unlike companies which have to market to sell so that they can be able to pay their debts, government just needs to tax, and to tax just needs to pass a bill in your parliament, and that's it. So on that basis, then it's risk of default is usually very, very low.
Okay, all right. So compared to the others, where you said, at least with the government, they're able to levy taxes and would then be able to pay that money back. David, we've done a little bit of an explainer on it, but talking about, how this is something that is decided by National Treasury. They present the budget, and then it is CBK that is basically doing this. What is the role then of the NSE in trading in government securities? Where do you come in?
All right, thank you very much, and I think you're an excellent teacher. I was just admiring you breaking it down.
Thank you.
I think that was really cool.
Thank you.
So the NSE provides an opportunity for people to exit. So for example, we have what we call the primary market. So at Central Bank, that would be the primary market. A primary market is where you buy directly from the issuer. So probably you'll remember the IPOs. Those are initial public offers. So an IPO is like a primary market where you buy directly the public from the issuer. The issuer is the person who is borrowing, say, from the public. And then the secondary market, which is the space we play, is whereby maybe after you've bought it initially, then you'd like to sell to somebody else, or maybe you want to get your money back. So how do we provide a market that is able to provide that? So if someone has bought maybe some bonds, you'd like to utilize it before the term has expired, you can actually come to the secondary market and actually be able to sell.
Okay, and now that you've mentioned that, it's typically not advisable to sell them off before the time of maturity. Why is that?
Yes, so if you want to get the most out of, say, a bond investment, say it is for five years. So every year they'll be giving you the interest, which we call coupon. So you'll be getting the interest over the period, and then at the end you get the money that you loaned them initially. So that way, if you want to get the maximum benefit from a bond, you actually wait until the maturity. So it actually allows you to be able to get the maximum benefit.
Okay.
So that's why we ideally recommend if you can wait until that time, and then you get the maximum benefit.
Most out of it.
Nonetheless, if you get a good deal, because also that's why we have a secondary market, then you can actually discover that it is probably trading more than you bought it. So that's where the secondary market comes in, and you can actually cash in and make some money instead of holding it to maturity.
Yeah, and that's interesting. Where are we getting information, Kevin, as to how these investments are performing? Like David has said, if you check and you find out that it's actually doing better, where is this information? For stocks and trades, and we're running those even at the bottom of our screen now, you're able to check, my shares that I bought in company X are doing well. So how do you then monitor your investment?
So there are various ways, and thanks for hosting us. So one of the ways is you can get the price list if you're talking about bonds and T-bills, and that you can get from NSE. That's where David is coming through. Okay. So you can also get these results from the CBK website. They're the agents who act on behalf of the Treasury. So you can get from them. And last but not least, you can also get it from us, the guys who are representing you, the intermediaries between you and the government, or you and the NSE. Okay. So you can get all these price lists, you can get statements from us, and that's how you're able to monitor.
Okay.
Yeah.
What are the key things to consider when, investing? So T-bills, T-bonds, obviously there's people who will say, well, I'd want the one that has the minimum, which is 50,000. But what are the key considerations when, you have this amount of money lying here and you're saying, I want to put it in there? Which one do you choose, and why and when?
So there are various ways or things to look at. So for instance, if you come to us at Genghis, we do a risk profile. So we look at you, Yvonne, you have 5 million, you need this 5 million maybe in 5 years when your kid goes to Form 1. So we can buy you a 3 to 5 year paper. that will be sufficient for that duration of time. But if you need maybe these, you're just putting money aside for 1 year, then we can put you in a T-bill. T-bill is anything 1 year and below. And as you mentioned them, so we have 91, which is 3 months, 182 days, which is 6 months, and 364, which is essentially 1 year. So again, you put your money there, we put your 5 million there. What you're buying is the face value. So you're buying face value from the government to receive back 5 million after, say, 1 year, which is the 364.
Yeah.
So the government, and you'll say, that's 5 million, so it's less than 20 million. That means you can quote non-competitive. So if it's anything above million, then you have to quote a rate that you need the government to give you.
Okay, just run that by me again. So if you have a little bit more than 1 million, it means that you are able to dictate the price?
So
what does that mean?
Between 1 million and 20 million. So 20 million and less, you can bid non-competitive, which means whatever the rate the government decides to give for that cash raising, you're okay with it. Okay. But if you have, say, 100 million, then you can't go in uncompetitive. You have to quote a rate and tell the government, okay, I'm giving you this money for 1 year, and I need 12%.
Because you're offering them a lot of money.
Correct.
But then many of the Kenyans we have, Johnson, I mean, figures like 5 million are sounding wow. Even I'm thinking, okay, so if I get to 100 million, I can tell the government what sort of return I want. But then perhaps that has been the idea that people have had, that you're loaning to the government. You need to have lots and lots of money. Why has this been seen as a preserve of, the very wealthy and the banks?
Maybe it's because people are looking for a certain level of return. So people are very ambitious when they hear the word investment. They know, put your money once and you get rich. And the problem with government bonds is you're earning 7, 8, 9, 10%. And even T-bills, remember, interest rates are quoted on an annual basis. Okay. So if you're talking about 6% on T-bill, it's actually 6 divided by, if it's a 91, divide by 4.
Okay.
If it's a 182, divide by 2.
Right.
364 is as is. So that's why people, and here's the interesting thing. The development of the capital markets in Kenya has been backward.
How so?
Ideally, in most economies, you develop the debt market first, and then you move on to the equities market, which is a little riskier for everybody else.
And the debt market we're talking about now, this topic we have today, bonds, the T-bills and the bonds.
Right.
Okay.
So for most people, you'll find that they have a more developed, they develop the debt markets first before they develop the equity markets. Okay. But here in Kenya, we develop the equity markets first. And people enjoyed very, very good returns on equity markets before they even understood what a bond market is. Ideally, a bond market is supposed to be easier. You're dealing with less risk. Your returns are pretty predictable. But that has not been the way Kenya has developed. So we are having to come back now and re-educate the public, right? Okay.
And on that note, let's hear from the public in a moment. Like we said, we went around the country and asked people's views. If you had 50,000, what would you do with it? Where would you invest it? And some of the responses we had were quite interesting. Watch.
Ndio trade in government bonds lazima kuwe na ile tunaita disposable income, which a lot of Kenyans hawana. They cannot afford kuchukua pesa na kuloan kwa serikali. Number 2, ile interest yenye inatoka ni kidogo sana. Naelewa ni around 1.5%, which is ukiinvest 50,000, 1.5% interest after tuseme 1 year ni pesa kidogo sana. Hiyo 50,000 ungeinvest in another opportunities kama ukulima, interest ni kubwa kuliko kuinvest in treasury bonds and bills.
Okay, so he knows about it, and you had a reaction, Johnson. So let's speak about Benjamin's concerns. So first of all, he talks about, low interest rate compared to any other business, and that you need lots of disposable income, although he did say, 50,000. So could you just address that? Is part of what he's saying right, that, the returns are lower than perhaps others? Maybe you could give us a comparison with stocks and...
I mean, so the trouble of comparing to the stocks is stocks are very volatile. 1 year you can have negative returns, 1 year you can have positive returns. Bonds, you're most likely going to get fixed income general, you're going to most likely get positive returns going forward. Okay. So from a risk perspective, it makes more sense to do bonds when you've got very little income.
Okay.
But remember, if I have 1,000 bob, I can invest in stocks. If I have 2,000 bob, I can invest in stocks. If I have 50,000, I'm just getting into T-bonds, right? So yes, if I'm looking for yield, I can actually get 13% per annum on bonds. But the guy doing stocks, if it's money he can afford to lose, he can either double it or lose it, lose 50% of it. Yeah.
Okay.
So
in a, it's like gambling, like a legal, you know, in terms of you put it in and you know you're not sure it could really lose the value or it could gain.
It's not quite like gambling, because gambling, you know, there's a certainty, there's like a 50% certainty of loss, right? The thing about stocks is that everybody involved in the stock market is working towards generating value. Okay. So that's where the major difference is.
Okay. Yeah. Okay. Kevin, you were also, you know, nodding your head when we listened to Benjamin from Baringo.
He's right and wrong on some things, yeah.
Okay.
So if I had him right, he mentioned 1.5%.
Yeah.
In my almost a decade of trading, haven't seen 1.5%, yeah, in fixed income.
Okay.
So I don't know exactly what he meant by that, but even when you look at, say, a 91-day T-bill, we're talking about 6.7%, you know. You go to half a year, which is 182, we're talking about 7.2. You go to 1 year, 364, we're talking about around 7.6 or 7.8 thereabout, yeah? When you're talking about now bonds, that's now, say, 2 years and above, we can talk to as high as 15, 16%. We saw those in 2016, you know. So there are less, as Nderi mentioned, they are an almost risk-free investment. And the reason we're not saying it's really risk-free is because the government can collapse as well. But before the government collapses, all your banks, all your SACCOs, all your shares, everything else will have collapsed. This is domestic debt, remember we are talking about. The government can always print money to pay you. Yeah, we can always raise taxes to pay you. The government can go to all sorts of lengths to pay you. So yeah, I think a fixed income for me is for that person who doesn't really want to keep an eye, to be at night looking at managements of the company, how the company is doing. I don't want to read balance sheets. I mean, fixed income is for you, you know. And contrary to what David also mentioned, I think he corrected himself towards the end, is you don't have to buy and hold to maturity. You know, you can buy a 5-year paper. After 2 years, something else better comes up, you know. And this, we talk about yields. That's the rate at which the bonds, or rather the price at which the bonds will trade at. Yeah, so buying a bond, you benefit in 2 ways. So you have dividends, which are paid semi-annually. You're paid every 6 months, every 6 months. That's around in June and December most of the time. And then now you have what you call the capital gain or the exit. So you bought this bond at, say, I-98 to the 100, and now you're selling it at 102 to 100, you know. So you're almost realizing 4 shillings. So whenever the market is right, and it will be determined on interest rates, yeah? Whenever the market is right, you can almost exit. You can always exit and get on to another paper. Yeah.
All right. For both of you, I think I'm going to give you just a little bit of an assignment so that at the end of this we're able to demonstrate. I think, Kevin, I'll give you the assignment of, you know, T-bills. Let's do one. For 100,000. Give us maybe, I don't know, I think I received those SMSs from CBK. Just if I purchase that one for 1 month or 6 months or 1 year, how much we would make at the end of that term. For you, if you can give us for a bond, we're buying just one. Let's see how much we can make with that.
Can I have a paper and pen?
Yes, I will give you a paper and pen for you to be able to do the math. And then, you know, sort of at the end of this, we can demonstrate, you know, what exactly that means for viewers like Benjamin who are saying, okay, you know what, the interest rate is really low. How much would I make with that? And we'll also be hearing a little more from, you know, other Kenyans who are saying, if I had 50,000, where would I invest it? It would be perhaps a surprise. So, David, let's talk about then what sort of education there is, because like Johnson said, there was, you know, a great idea of putting in, you know, first of all, investment, development in equities first before debt.
Yes.
So what sort of information is out there? Is NSC doing something to, you know, increase financial literacy amongst people for them to get a better understanding of so that they can make informed choices if they want to indeed trade in government securities.
Yeah, I think you've actually said it. NSE is really at the forefront of actually rebuilding the market. One of the things that we are really keen on, like Derry did mention, and also Kevin has mentioned, is when you start to invest, there's usually what we'd call an investment tree. So you first start off by investing in the less risky assets before you go to the more risky ones. So the bonds and the T-bills would actually fall in that category. So one of the key initiatives that the NSE was at the forefront of is actually M-Akiba, whereby people like Benjamin from Baringo, they could actually use their mobile phone and actually be able to trade in government bonds. And also, to his concern, what is the minimum amount? So unlike the normal bonds that are at 50,000, M-Akiba was only 3,000. And what we would say is that you can actually get in as early, with as little as 3,000, and there was no ceiling to it.
Yeah, and you've gotten into that of government bonds, and we saw M-Akiba, and we saw it was, heavily advertised.
Yes.
So talk to us about that type of bond. What was it? What was the minimum? What were they using, the money for? And, are we likely to see another one? So just explain to us at least M-Akiba as an example of how you can do with less money than 50.
Yeah, so it was actually to promote financial inclusion, to bring in as many people into the market as possible. And also, of course, like from Safaricom, when we did the Safaricom IPO, many people lost money. Why? They didn't have a savings culture. People would take loans, say from their banks. I know one of the banks was really giving out many loans. Yeah. So people were actually able to buy, to get a loan and invest. But it should actually be from savings. So M-Akiba is both a savings product as well as an investment product in its own right. And I'll qualify that in a short while. Because you see, M-Akiba is really about, you take your hard-earned cash, you put it in the bank. Banks take it and put it in bonds. So that's why they are always making money. So why don't you take your money and take it to where the banks put it? Even from English, you say you can take my word to the bank. You trust the bank. And then the banks also trust the bonds. So all banks actually invest in government bonds. So the whole concept of M-Akiba is for retail people out there to be able to buy government bonds, get the same type of return. And the return is not small. Like Kevin has corrected, it goes for the M-Akiba was giving 10% with no taxes. So if an hypothetical case would be, if you had 3 million, and I know you say that's high, you said you can start with as little as 3,000, but giving an example of like 3 million. 3 million, instead of getting a house for rental income, in Kenya people like to invest in real estate. That money would be better off in a bond, because 10%, it was giving a 10% in tax-free return. So 10% of 3 million is 300,000. That's a whole year. And then if you divide that by 12, if you are to see how much income you'd be getting every month, that would be 25,000. So with 3 million, can you be able to get a house that is giving you a return of 25,000? You're not paying any taxes. You're not hustling with any tenants. It is coming looking for you. So that's the beauty of it. And the other second beauty of it is that there's no return of the money. He talked about business. So when you go out in business, there are risks. COVID hits, different things. You get duped. There are many other things. But here, if you put your money in a government paper like M-Akiba, you are guaranteed you'll still get your money back. I actually invested. I got back my money and I got to invest in other areas. So it is a very safe way, even for people to start, because we are saying you can start with as little as 3,000. So that one just keeps you started. And then every time you get some money, like a piggy bank, instead of teaching our children how to put money in a piggy bank, they should have open M-Akiba Junior accounts.
So how come we didn't meet you then?
Sorry, actually, actually, right now...
I should have known you then, David.
But the government is actually in the process of probably reissuing and repackaging it so that it comes out better and also more friendly even to the people. So that is what is currently taking place, but it will definitely be back. I think we have a huge, the government needs to raise a lot of money, especially locally.
Yes.
And I think getting it from Kenyans would be one of the most better win-win avenues, because the citizens get to benefit from it.
Right.
And then also the government benefits, everybody benefits.
Okay, everybody wins. What are the factors to consider that could affect the level of returns, because David has talked about, if you put 50,000 in a business, it could, lots of things could happen. But I think before you answer that question, Kevin, maybe we listen to another Kenyan whom we asked exactly that question. So you've got 50,000. What do you do with it? Where do you put it? Where do you invest it and how?
Nikipata 50,000 naweza invest kwa M-Pesa na agency ya cooperative na agent ya Equity. Sijui maneno na bonds. Sijui kabisa.
So, now that he's talked about he would invest it in an M-Pesa shop and, a couple of other interests, and David had mentioned that all of these other investment options, have their risks, and it depends, a lot on what's happening, the environment. You could also put your 50,000 shillings in a business that, collapses. What are those things we say about most businesses in the country not making it past their 3rd birthday? So everything has risk, but what are the risks that are inherent or some of the factors that would affect the yields in government securities, Kevin?
Thank you. I think it will only be fair if maybe I take a minute or less to explain just the kind of bonds we have and the bills we have.
Okay.
I think we've just delved into the details of rates and everything, and a good number of folks like the gentleman doesn't understand. So there are 2 types of bonds.
Okay.
We have the fixed deposit bonds and we have the infrastructure bonds. So the difference between both these are issued by the governments. Yeah. So the difference between these 2 is one is tax bearing and the other one is tax free. So infrastructure bonds are issued. The problem with our country is we don't have an economic calendar, sort of like the US, right? So you can't say in July or August, this is the kind of bond that will be offered. So we know traditionally that the government issues or auctions a bond every month.
Yes.
But most of the time that will be the fixed coupon, bond, which is the one that attracts interests. So amount, I mean, any tenure or duration of a bond above 10 years, the interest rate on that is 10%. Below 10 years, the interest rate of that is 15%. So infrastructure bonds are traditionally issued once.
Withholding rate.
Withholding. Yes.
Okay.
Withholding tax rate.
Yeah, withholding tax rate.
Right.
So infrastructure bonds traditionally issued once or twice in a year. So one will be issued, like now I think we've already seen 2, if I'm not mistaken. And there's a chance we might see another one we call a Christmas gift towards the end of the year.
Okay.
Yeah, so that will be a taxless. And you'll find rates as good as 12.67%. So you give the government 100,000 shillings. Every year you'll be paid 12,600. Semi-annually, of course, now you'll be paid 6,300 after every 6 months.
Okay.
And at the end of the, say, 5 years, if you bought the IFB, you get back your 100,000 and 5,300 again. That is your interest at that point.
And no taxes?
No taxes on the infrastructure bonds. So unfortunately, you can't say when they will be issued, unlike the others that are issued every month.
All right.
So in terms of things to consider, to your question, what's your question again?
The factors that, affect the price, as an investment, when you take a look at the risk. So what would be the things to consider that could affect the prices of it? Just like we say, stocks are volatile. It depends on, I don't know, in this country we don't...
So in fixed income, various things will affect the price of your bond. So one of the things that will affect is if a similar bond has been issued. So you bought a 5-year bond, taxable, let's say 15%, and in the next month the government reissues another 5-year bond, and maybe this time, because they didn't get as much money on the first one, this time they decide to give a better rate. So the aggregated average rate goes higher. So you bought your bond at, say, the coupon says 12.5%, and the next bond is issuing coupon at 12.97%. So automatically your bond becomes less valuable.
Okay.
So and a couple of other things also in terms of how the government needs money, where similar papers which I've just mentioned are trading at, and if alternative investments are performing better than the bond market. So those are some of the things that will affect the price of your bond.
Okay, all right. I want us to take a break. When we come back, we've got much more to discuss, and I see a couple of questions. What's the difference between T-bills and T-bonds in terms of yield and risk? So we'll get into that and much, much more. So keep your questions and comments coming. The hashtag is Business Now at Citizen TV Kenya. We look forward to hearing from you in just a moment when we return.